Hey everybody, how is everybody doing? Welcome to the session. Today is April 21st, 2022. This is SMARTT Tiger Live. My name is Jose Blasco. I will be taking care of the session today. We're going to be... Sorry for that. Give me a second, guys. Welcome to the session. Today is April 21st, 2022. 1 second. I was having the sound go back to me, so I was hearing myself twice. Sorry for that. Again, my name is Jose Blasco. I will be taking care of the session today, as I was saying. The name of the session is SMARTT, which stands for Special Market Analysis Report for Tiger Traders. And one of the reasons why it's very smart is because we don't look at the market simply by looking at candles or a chart. We also use options data to understand better what's happening from behind the scenes. Options being a very relevant asset, which is commonly used by the largest market players, the institutional traders, the fund managers, etc. Many times analyzing that sort of data give us clues of what may happen in the marketplace altogether. So that's why it's smart. And we're going to talk about this. And of course, we cannot talk about it without talking about options, and beyond talking about options, even going through some options lessons as we do every time that we meet, where I share a little bit more and more about options trading, so you guys keep developing yourself as powerful options traders, okay? Before we get started, I'm giving a little bit of time for everybody to be connected. I would really appreciate if you could, on the chat box, just type a quick hello. That would be great, because it would kill two birds on one stone. Number one, now I know sound is good, you hear me well, we are ready to go. Number two, it's a kind thing to do in a community, and you know, the Tiger Brokers community, it's amazingly amazing. So please go ahead and be generous out there with a quick hello for everyone. That will make everybody happy, including myself. Please go ahead and do that. And in the meantime, as I am now ready to begin, I wanted to point at the upper left side of the screen where there is a financial disclaimer. You're probably used to those disclaimers, but I do need to point at it. It's fairly short. It's relevant information. It's important, and I would certainly appreciate, maybe you have done it already, if you could read it completely. I am indeed counting on that, okay? Thank you so much, everyone. And by the way, for all of you to know, as we begin now, I am watching all chat boxes. So if you are on YouTube, I see you. If you are within the traders, the Tiger Brokers app, I see you too. So make sure you take advantage of this time that we have together, around 45 minutes or so. So you can ask as many questions as you want. If the answer is coming later, let me be the one to tell you. If we need to have a special session about something specific that you need, I'll make a note of that so we can organize that in the future. But make sure you are not shy. Make sure that you interact. It's going to be so much better for everyone if you do. So please do not be quiet in your corner. Make sure you interact with me, okay? So far, I got very few hellos, okay? Which means that some of you are in a little bit shy mode. So please do not be, okay? We all, at some point in our lives, started learning how to trade. And if the reason why you are a bit on the shy side is because you feel like, okay, I'm just going to be listening to this and we'll see later. Again, open up, my friends, because again, we have all been there beginning learning how to trade. Okay, so no issues at all, guys. Okay, we're here to learn. Okay, no issues. Anyway, so let's begin the session for today. We're going to talk about very brief introductions. We'll talk about headlines. Things are happening out there in the marketplace. We need to be aware. We need to be well informed. Then we'll talk about the lesson of the day, which is very important today. I mean, like most of the sessions when we run a lesson, we do it for a specific purpose. So today we'll talk about implied volatilities, something absolutely critical in the life of an options trader. Then we'll have a market commentary. I have a bonus for you as well, a little something that will help you to trade better, which is going to be free for you. So stick with me until I get to that slide. And then, of course, Q&A. We can certainly take care of the questions at the end, but I would like you guys to type your questions as the session progresses. That would be so much better, okay? And also, I see some of you are typing in Chinese, which I so wish, my friends, I could read it. I could certainly speak a little bit of Chinese, okay, especially when ordering food and things like that. Now, some of you are maybe laughing. Food is important, isn't it? But anyway, so if you have trading questions, you know, I would appreciate if you could type it in English, or if you cannot, and talking about community, if some of you could take those Chinese writings and translate to English for me, that would be super appreciated. So now I can help you all by you guys helping me to help you all, and we are just working as a team. On top of that, is more fun like that, isn't it? So do that, please. Anyway, so quick introduction. As I said, my name is Jose Blasco. I don't want to make this long, really, because some of you may have been in my sessions before as well. So you kind of know me. I am a multi-asset trader. Options is my favorite asset. There are many reasons for that, as you are probably discovering through these training sessions that we do together. But again, everything in life got pros and cons. Trading too, options too, futures too, equities too. So to me, being surrounded by a collection of assets and a proper broker, in this case, we are, in very good company, right, with Tiger Brokers. So being surrounded by the right tools to trade, right broker, right asset, etc. To me, that makes a big difference. It provides an edge for you in the marketplace. Okay, so that's what I do. Before being a trader, I started in 2008. I used to work in the telecommunications field, and my background is technology. I used to be a professor in the University of Valencia in Spain, which is my country. But anyway, all of that is not too relevant. So I'll keep going. TradeWithUFOs.com is the website where you can find us. The name of our company is Tradictive. We normally operate the website, not that we normally operate, we operate various websites, but the one with the greatest volumes is TradeWithUFOs.com. And if you wonder about what are the UFOs, well, they look like flying saucers. They represent on-field orders. And because of that, now you can use them for entries and exits or confirmations of other trading methodologies. And in this case, it makes your trading more simple. You spend less time trading and it makes it more powerful. Okay, so I use it for everything. Having said that, what I'm going to teach you today could be used combined with the UFOs or without the UFOs. What I'm going to talk about today is options trading. And therefore, the concepts that you're going to learn, not only today, but all the sessions I'll be running are concepts that apply to no matter which trading methodology you use. So that way, I don't limit anyone. Okay, so what I'm providing you here, guys, is something that is good for everybody. Okay, so just for you to know, even though as a trader, I also have my own preferences. UFOs is one of them, and for sure, from time to time, I'll give you examples of that. Okay, cool, very good. So here we go. Coffee Cup, I see you there looking to buy the S&P 500 index. Well, a little later in the session, we're going to do market review, market analysis, okay, in our SMARTT, isn't it? Market analysis, and we're going to be talking about that. So let's begin with the headlines, okay? So what do we have? Well, the two on the top have not changed since the last time that we met. Russia and Ukraine, it's still a very, very, very big thing happening out there. Everybody's watching it. The moment something happens, something changes, next thing you know, the market is reacting. The market has been very undecisive in recent times, even though the speed of movements are not a joke, but the market has been indecisive in the sense that if you look back in time, market went up and down and up and down and kind of, in a simplistic fashion, I would say kind of stay in the same place. And this has a lot to do with sometimes good news and bad news coming in, and, many buyers show up, many sellers show up. And again, there is a big fight there. Probably, waiting for, more clarity on these, international, problems and situations that obviously are very concerning at so many levels. So the other big item that we talked about in prior sessions as well is the inflation, the US rising interest rates. That's not a surprise, but how much are they going to rise them? 0.5 point, 25%. 1 full point, 1.5 point. So again, all of those things are very much impacting the markets very much as well. And this is something to watch. And recently, not to be more specific, with a specific company and a specific gentleman in this case, we have Mr. Elon Musk bidding to buy Twitter. And obviously this could revolutionize the whole technology industry, because stocks like Twitter, which are quite relevant, impacted by either trading actions or rumors coming from Mr. Elon Musk, like it happened, for example, with Bitcoin a few months back. So history proves us that those things could generate impacts that could propagate into other stocks and therefore the sector. And if it impacts a sector, may end up impacting the whole market, especially Twitter being a technology company, and therefore the Nasdaq index being loaded of technology companies. So if the Nasdaq index is moving aggressively in one direction or the other, the potential of impacting the S&P and therefore the overall S&P 500, the overall US market, it's quite significant. Okay, so keep that in mind. Those are news to watch. Again, in my trading style, I rely more on charts and technical data and options data, as you will see in a moment, for my trades. But certainly, all of this is very relevant. Okay, good. Let me go ahead and take a look here for a moment at the stream to see if I'm not missing any question here. Yes, very good, guys, very good. So I see some of you have been posting in Chinese. Okay, and again, know that unfortunately I have limitations to read you, or maybe something happened to the app and for whatever reason it changed the language. But give me a second, guys, because I would really want to be able to read you like I normally do. Not sure why today I'm not able to read you as normal. Okay, not sure why. Okay, so anyway, so if you type a question and you see that I'm not answering, if you could retype it in English, that would be super useful to me, guys. So anyway, when it comes to earnings reports, today we got 98 companies reporting earnings. Of course, many of those reports are not that relevant. So I pointed at the ones which are most relevant, which in the cases today, they're actually quite relevant. We're talking about AT&T, one of the largest utility companies in the world. We're talking about American Airlines Group, one of the largest airlines in the planet. Snap, also pretty significant in the world of social media. Philip Morris, that's tobacco, isn't it? And Union Pacific as well, a pretty, very old company in the US market and very relevant as well. So this is what we have out there. So again, if you are planning to invest in such companies, if you are holding shares from those companies, make sure you are aware of the earnings. Make sure know that even during the pre or the post-market session, you can also act on either exiting or entering trades. It doesn't need to be only during the market hours, because those companies, they typically report their earnings either before the market opens or after the market closes. Okay, it's rare. There are a few, but it's rare to find stocks that report earnings during the trading session, okay? From 9:30 a.m. to 4 p.m. New York time, which being in Singapore is 9:30 p.m. to 4 a.m. Local time, right? So just keep that in mind. And if you consider maybe closing half of the position, whatever is part of your trading plan, just know today is the day, because earnings may create a gap, which of course can be in your favor, but could also be against you. And when you have a gap, stops will not help you, correct? Stops don't protect against gaps. With options, that's a different story. But if you own the shares, be careful about that one, okay? Cool. So the lesson for today: using continuous implied volatility to avoid falling into any options pricing trap. Okay, so keywords here: options pricing, keywords, options trap, keyword, implied volatility, keyword, continuous. Very rich title, to be honest with you. I mean to say many things with this title. So the lesson is going to be quite rich today. Listen carefully. If you have been in my sessions before, I tend to speak quite fast. So if I'm speaking too fast, please let me know. Happy to repeat. If I'm going too slow, let me know too. I don't think that would be the case, but let me know too, because I don't want to bore you, but I don't want to overwhelm you. And know that the subject today is absolutely critical. An options trader who does not understand implied volatility and its impact and its characteristics is basically devoted to make money out of how lucky that trader would be, instead of having a proper process where options parameters are under control. Next thing you know, that trader is exposed to, let's see how lucky I'm going to be today. Okay, and we don't want to be that guy, right? Because this would fall in the world of gambling versus the world of trading, which, again, some of you, and all respect, obviously, for every decision out there. Some of you may say, look, I just put a little bit of money in my account. I'm just having fun. To me, it's just a gambling thing. Great. Nothing wrong with that if that's your approach. But just know that in my presentation, and all presentations, to be honest, I'm a professional trader. So my approach is trading as a business, creating consistency, having repetitive actions that lead to mechanical approach to trading, that leads to consistent action, that leads again to consistent results, instead of, hey, let's do this, maybe crazy, let's see what happens, right? So that's not my approach. And continuous implied volatility is a key element in order to not to be exposed to, let's see what happens, but instead, let's be exposed to odds in your favor, let's be exposed to trades well done, to risk under control, etc., etc. Okay, cool. So let's do that. First, what's implied volatility? Well, implied volatility measures the expected magnitude of a move on a stock. And let me tell you as well that I think it's 4 or 5 slides, something like that, to cover, and then I will jump into the real-time charts. So I will actually show you the implied volatility real time. Okay, so no worries about that. Okay, no worries about that. But again, keep in mind what I just said here, that implied volatility, it's a number that measures the expected magnitude of a move on a stock. And you may be wondering, how does someone knows what to expect from, how far and fast a stock is going to move, right? So we'll talk about how that is derived. It's kind of like a reverse engineering process, if you wish, and we derive to that conclusion, as you will see in a moment. Okay, but again, the implied volatility measures the expected magnitude of a move. And expected means in the future. So expected magnitude of a move, because volatility typically means how fast a stock is moving, right? So if you say the market is volatile, it means the market is moving very fast. And that's in the past. It may be 10 seconds ago, but that's still the past, right? So when we talk about implied volatility, the word expected means in the future. So it's the volatility that has not happened yet. This is what we are looking for when defining and using implied volatility metrics, okay? So now, in the future, we are also looking at everything in options trading is measured. You could measure it in other ways, but by definition, by default, in trading platforms, options websites, all over the place, everything it's accounted for in 1 standard deviation multiples. So when we say, for example, as you can see in the example below, a stock got 22% implied volatility, it means that we expect it to move at a rate of 22% in 1 year, okay? And that is within a 1 standard deviation, okay? If you know about statistics and probabilities, and again, if you are a pure mathematician, please allow me to be simplistic here so everybody understands, even though my background is engineering, so I love math myself, okay? And, I'm really gonna oversimplify 1 standard deviation, but, again, if you allow me to do it, 1 standard deviation means what tends to happen normally, what happens most of the times, in this case, what is expected to happen in a normal condition. And a normal condition is 68.28%, I believe it is, something like that. So 68 point something percent. That's 1 standard deviation. So in other words, in most of the cases, the expected move into the future would be 22%, either up or down, right? And in how long? 1 year. Why? Because options pricing models, by default, they are all set up in ways where everything is accounted for 1 year. Of course, then you can break it down. You can use those formulas and and calculate what's the expected move in 1 day, what's the expected move in 1 week. So you can certainly then break it down. But the number 22% represents the expected move, either up or down, in 1 year from now, and it's a percentage. Okay, so again, I'm going to show you examples of that later on. And most importantly, I will explain to you where it's coming from, and even more importantly, how to use it, which is the key. So now that you know what's implied volatility, okay, the word implied comes from the fact that we're going to get to that number in this example, 22%, out of looking at the options prices. So we are not going to look at the chart and be like, okay, the stock has been moving at a rate of 10%, so its volatility is 10%, because again, that's called historical volatility. That's actually in the past. That's what the stock has done. Okay, the stock may have moved at a rate of 10%. But while the stock has moved at a rate of 10%, the options prices are telling us in this example, the stock is likely going to move 22% either up or down. That's the expected move in the future. Okay, so again, I'm kind of repeating what I said before. I wanted to point at the word implied, because that volatility measurement of 22% is implied the options prices, right? Okay, we'll talk about this in more detail in the slides coming and in a moment with the trading platform real time. Okay, bear with me, guys. So what's the meaning of that number? Well, the current available options prices, which we call premiums, are the consequence of how many buyers and sellers are available at this particular moment in time, as well as how aggressive or passive they are. Are they buying calls like crazy, like, it's going to the moon? Are they buying puts like the world is ending and they are absolutely not patient? They just want the trades immediately. They're using market orders. They have no patience to wait for good prices and getting filled. They just want it now. Are they aggressive like that, or are they passive? No rush. I'll buy a call, but only if the call is trading at 1.1, right? So how aggressive and passive they are there more buyers than sellers? Are there more sellers than buyers? All of this ultimately dictates the options prices, and that intense or non-intense activity denotes the expectation for how far the price of an underlying stock will move. If everybody, let's say everybody, we saw that clearly, for example, when the war with Russia and Ukraine started, and the stock market was falling hard. So at that moment in time, there were many put buyers that were buying puts very aggressively, because they were expecting a very large move to happen. In this case, if they're buying puts, they expect the move to go down. But the point is that they had no patience to wait to buy the puts at a very good low price, because they were very fearful. And fearful is another way to say excited, because we say fearful when it goes down, we say excited when it goes up. So in the end, they were not patient. They expected a large move, and that's why they wanted the trades now. So what happens if many people are buying with no patience? Well, if many people are buying with no patience, the prices of the calls or the puts, or both, they will go up. And that increase in the prices of the options, even, and listen to this carefully, guys, even if the stock has not moved yet, if many people are buying calls and puts, like the world is ending, or like the stock is going to the moon, right? And they are buying so aggressively, so the prices of the options will gain value. Why? Because you got more buyers than sellers for the options, even if the stock has not moved yet. Remember, we covered in prior lessons that options prices have two portions. The intrinsic value of the options prices, which is only impacted by the stock either moving up or down. But then we had the extrinsic portion of the options prices, which is the one that would gain and gain value if people were to buy like the world is ending or the stock is going to the moon. Right? So in other words, when you look at those options prices, you could extrapolate by kind of reverse engineer the options pricing models, how much people expect the stock to move, right? Because, if the options became way too expensive, some people that were very eager to buy them, they may decide, you know what, I'm not buying them anymore. Options became too expensive. And given my expectation for the move, given how far my target is, those options are too expensive. My reward to risk ratio is not good enough. I pass, right? So in other words, the less people are buying or selling, the less of an expectation. The more people are buying or selling, the more of an expectation, if you wish. Okay, and therefore, you get here the meaning of implied volatility. So high implied volatility values represent pricier options. Low implied volatility values represent cheaper options. Please, everybody on the chat box, okay? On the chat box, everybody, I need everybody now, okay? So counting on you. Type on the chat box, when you buy options, it doesn't matter if it's a call or a put. When you buy options, do you want them to be pricey or do you want them to be cheap? How do you want them to be? You want them to be pricey or you want them to be cheap? Please go ahead and answer this question in the chat box. And yes, Natalie, the session is indeed recorded. You can then go back to either the YouTube channel or the Tiger Brokers app, and you can see the recording there, and you can play it as many times as you like. So no worries about that. So everybody, please, counting on you guys, okay? Collaborate, work with me on this so you can get this, okay? Because this is, as I said earlier in the presentation of the session, this is absolutely critical, okay? So work with me on that. What's the classical trap? Well, buying a high implied volatility call or buying a high implied volatility put may lead to situations where the stock moves your way, but then you don't make money. You either lose money or make just a little bit of profit, while the stock may have moved in your favor significantly. So, what was the problem? And very well said, Natalie. Cheap. When you buy options, you want them to be cheap, right? So what if you bought a high implied volatility call or a high implied volatility put? Well, as it says on the top of the slide, high implied volatility values represent pricey options. So if you bought a pricey option, that's starting at a disadvantage because you bought something expensive while it could become more expensive. It would require the stock to move quick and fast, because if the stock was to move your way, but was to move slow, what would happen to the expectation for the future move, which is the IV? It would come down. And if the IV comes down, what would happen to the extrinsic value portion of your options contracts? It would shrink. So now you have, instead of having two forces working your way, which is intrinsic value gaining value because the stock is moving my way, and extrinsic value staying the same or gaining value because there is more expectation building up because the stock is moving fast in your direction, instead of that, you have the intrinsic value moving your way because the stock is moving your way, but the extrinsic value is shrinking, shrinking, shrinking. Why? Because it was way too inflated when you bought the option. Another stock is moving, but is moving at, let's say, a normal pace. So now the expectation for the future move is less and less and less every day. And now next thing you know, you get to your target and you may have lost money, or you may have made very little amounts. And now the trade is very disappointing and you wonder why. That's a classical trap. Buying options without understanding what's the IV at the time of the trade. What's high V? What's low V? How do you measure it? How do you scan for it? How do you adapt to it so you can start at an advantage instead of starting at a disadvantage? Okay, so very well said there, and also same to you as well, ZZJ, good one there. So the opposite is true for selling options. So what if you sell options? Well, I'll say it this time because you guys said it right, so no need for me to ask again. But when you sell options, how do you want them to be? You want them to be expensive or you want them to be cheap? Well, of course, you want to sell expensive. You want to sell the pricey options. So what if you sold options without knowing what's the IV? And what if the IV was actually low? So you just sold cheap options, and now while time decay is working in your favor, because time always passes in the same direction, right? So time always moves forward, never goes backwards. So in that case, you sold an option, time decay is working for you, but it's working very slowly. Why? Because there is very little decay to take place. Why? Because you sold a cheap option. There is very little IV in the option you sold, and therefore the rate of time decay is going to be slow. Why? Because it needs to be zero on expiration date, but since there is little value, then there is little to decay, and therefore you started at a disadvantage. Okay, so it's very important for you guys to have this absolutely well under control, and I will show you how to do that. Okay, now beyond the concept I just got you introduced to, which is the implied volatility, right? Our options in the cheap side, our options in the pricey side. Beyond that, know that you could also break down the implied volatility for the calls and the puts separately. Okay, and I'm going to show you that in the charts. This is my last slide before I move into the charts. Okay, so IV is normally calculated using both calls and puts together. So you understand if options are overpriced, underpriced, great. A very interesting application would be to look at the implied volatility, the continuous implied volatility, which is real time, and apply it to calls only, and then do the same and apply it to puts only. Two things may happen when you do that. So instead of getting 22%, like in the prior example, you may get, for the call CIV, you may get 25%, and for the put CIV, you may get 18%. So what if instead of getting the midpoint of those two values, which is the calls and the puts combined, you get 20-something% on the call and 18% on the put? You got more IV for the call and less IV for the put. Well, guess what? That's a bullish sentiment building up in the options arena. Okay, why? Because the only way the implied volatility for the calls is greater than the puts is because either more calls are bought than puts, or more puts are sold than calls, or both together at the same time. And that's a bullish sentiment. Why would you buy calls? Because you're bullish. Why would you sell puts? Because you're bullish, right? The opposite happens when the put implied volatility is greater than the call implied volatility, right? So if more puts are bought than calls, which is bearish, or more calls are sold than puts, which is bearish, now you will get that effect where the put continuous implied volatility is greater than the call continuous implied volatility, which is a bearish sentiment building up on the options arena, and the stock may have not moved yet. But when that's building up from behind the scenes, guess what's likely going to happen later on the stock price chart. Okay, now you're gonna see those candles moving, and you kind of knew ahead of time that this was going to happen because you are looking at options data. So let me show you all of these. Okay, I'm just gonna move now to the charts and show you all of this so you understand this much better. Okay, before I do, a quick one. If you want to take a screenshot or you want to have a quick picture with your phone to this QR code, this is one of the tools that we use all the time. It's called AutoClimate. It's a tool that is available on our website, tradewithyourforce.com. It's chargeable, but with the coupon code CLAIM8, as you can see there in the middle of the screen. And this is thanks to being part of the Tiger Brokers community. So with that coupon code, basically you get this for free. It's an application that works with TradingView, and you can do a pretty interesting market analysis, as I will do later, to the S&P. So bear with me on that, but take a screenshot so you don't miss it, and we can talk about this later. Okay, so I'm going to stop sharing my screen so I can move from the PowerPoint presentation, which I'm done with, to the real-time charts. So that also implies that meaning my video stream, will go away. So now I guess you see me full screen. Let me move to sharing this particular screen. Here we go. And now I will be gone. And now you are probably seeing my screen, which is what matters the most. And I'm now moving to the trading platform. Okay. So what do we have here? Look, I am using top. Okay, top. I'll just write it down for the ones of you that have not seen it before. Okay, top. Okay, top stands for the Predictive Options Planner. This is one of the tools that we, as a technology company for traders, we have built. Again, you don't need to use this tool. Probably it will help you very much, but you don't need to use this tool. You have the Tiger Broker app. Okay, you can work with that. Again, everybody look at trading differently. In my mind, it's all about technology. So I love to have additional tools. So I'm going to use this because also I'm going to be very visual by showing you what I'm about to show you. Okay, so take a look at this. Okay, right here I have a tool in front of us which is called the Matrix, and this tool is looking now at all stocks in the U.S. market. Okay, so instead of looking at this, I was to look at stocks that are with a continuous implied volatility. Okay, continuous implied volatility, mean. Mean means the midpoint between the call and the put. If I look at the mean being less than 20% of the range, I end up with those various stocks. Okay, I have multiple stocks here in the list, and for example, here I just clicked on Prudential, which is one of the companies I just picked out of the list. It could be Oracle, anything. And when I do that, so here's the chart of Prudential, and in the bottom part, this is where you can see the implied volatility. Okay, so the current implied volatility for Prudential is 26. What does that mean? That means that the expectation for a future move it's 26%, 26% up or down in 1 year. That's what that numbers represents. Okay, now this is interesting to know, but this doesn't give you any edge on either going long or going short, deciding to be a buyer, deciding to be a seller. This is not going to help you in that sense, isn't it? But it is very, very important to look at this, because notice that if you were to look at what's high for that stock, we're talking about values around 40, and if you were to look at what's low for that stock, we are talking about values more or less starting at 26. So this is the bottom 20%, this is the upper 20%, let's call it the 80% above and above. So in other words, currently the implied volatility for the stock is in the lower end, and therefore options are cheap. So of course, if you buy, let's say you buy a call on Prudential and it goes against you, right, and it falls, of course you're going to lose, because buying a call only makes a profit if you are right in direction. It has to go higher. But at least you know that as you start this trade by buying a cheap option, okay? Because if you didn't do that, for example, take a look at this. This is extremely important again, guys, okay? I'm sorry to repeat myself, but I want to help you to avoid those classical traps, mistakes that we all make when we are new trading options. It's critical. So for example, I guess we all agree here that options are very expensive, okay? Options were priced at a level where the expectation for the move was 40% a year, either up or down. Okay. So now let's say the stock is falling, and that day you decided to buy. If you decide to buy that day, you may say, I bought that stock at 102.50. It went all the way to 120 something. That's a fantastic profit. From here to here, it's a beautiful move. What a nice profit. Yeah, indeed, you were right in direction. But when it comes to your profitability, quite disappointing. Why? Because look at what happened to the implied volatility. It went from 40% to 20 something. Okay, why? Well, because when you bought the options, implied volatility was too high. So other option strategies could be employed at this stage, which is not buying a call. You could do other things. We'll cover all those things in lessons one at a time. So you could do other things here to be able to take advantage of the move without suffering the fact that options are expensive. But my point today with talking about implied volatility is that imagine what would happen to a trader who buys options that day without knowing even what implied volatility means, without knowing even the implied volatility was 40, and now sees this beautiful move happen in your favor. And next thing you know, your profit is like 25% of what you expected, or you may even end up with a loss, even though you were right from 102 to 121. And you're gonna be like, what just happened here? Is something wrong in my computer? Is something wrong in my phone? What just happened? It will not be explainable. And the issue for a trader going through this issue is basically that did not take into consideration where was the IV. Okay. So now today, for example, okay, so Prudential is trading here. Okay. So if Prudential falls where the green UFO is, okay, I would love to buy here and expect a move for this to continue. Okay. Great. There is a great situation here with a potential all-time high situation going above this pivot high. So, if it goes high, it may be going to 132. That would be my target. So I'd love to take a trade if that stock drops to the green UFO and set my target up here. And in this case, buying a call would not be crazy because options are cheap. Okay. Implied volatility is low. I know this because I scanned it with the matrix and, you can see it on the chart. Okay. But not being aware of this could be extremely problematic. Okay, and the worst is that then people don't understand why. Okay. Yes, Natalie, each trading platform will have slightly different measurements of implied volatility. Our platform utilizes the binomial pricing model, which is the most advanced. Platforms such as TOS, as you mentioned, utilize models which are a bit more, let's call it outdated, such as Burns and Standards, which is a difficult name to pronounce to people from Austria. Sorry for that if any Austrian is with us in the session today. Yeah, so you will have a little bit of a difference. But I'm sure that if you look at the chart, while you may have 26, you may have a different value that is not 26, you may still see that implied volatility number to be quite low when looking at the range of what the implied volatilities have been through time, okay? That's the point. You are buying low IV instead of high IV. The number doesn't matter because if I pick another stock, for example, Oracle, instead of 26%, it's going to give me 24. If I pick, BHP, instead of 24, it's going to give me 32. Instead, if I look at Tesla is going to give me 63. And 63 is 3 times more than 20, but it's still low IV because Tesla may go all the way to 85. Is that making sense? So again, that's the point. Okay, low IV is relative to its range. It's not the number. It's relative to its range. Okay, so very good comment there, Natalie. Very, very well said there. Fully. I'm not saying everybody go ahead and buy calls on Prudential. That's not what I'm saying. Because the key really is the timing. Okay, you need to wait for. In my case, I was pointing at that green UFO, and everybody has different trading techniques. So the point is that given your trading technique, you will have a different timing for when you buy the call or when you buy the put. That's your trading methodology. Mine is the UFOs. But the point is that if you buy a call today, no matter your methodology, calls are cheap. That's the point. So you start at an advantage instead of starting at a disadvantage. Okay, again, I'm repeating myself, and the reason why is, I do it often because it's for educational purposes. I guess we learn through repetition, but also because it's a very relevant concept. Okay, now very quick, what if you did the opposite, right? So which is, I want options which are very expensive. So I want them to be CIV mean greater than 80. So if I was to do something like that and pick Facebook, for example, okay, I should say Meta. So look at implied volatility for Facebook. It's all the way here on 61, but not only is 61, which again, the number doesn't matter. Look at that, is the highest it has ever been in that whole chart, right? So if you were to buy those calls or puts, you may have Facebook give you a fantastic move, either up or down, and then you lose or you make very little money, and you would be like, why is that? Again, you bought an option that was way too pricey. Okay, so that's the lesson. The last point I want to add before our market review, our market commentary, is that on top of looking at, options being expensive or cheap, I'm going to go back to options are cheap, less than 20. And by the way, that 20, Natalie, maybe your question came because of this. That 20 is not 20%. It's 20% of the range of IVs, right? The bottom 20% or the higher 80% portion of the range. It's not 20% IV or 80% IV. Okay, sorry for that if I did not explain that right. Anyway, so I'm looking at cheap options. Okay, 20, options on the 20th lower percent range. But also I'm gonna add now something else, which is I want the options to have a positive CIV spread. So remember how we said that you could be looking at options, IVs, and you can look at it like calls and puts combined, but you can also look at the call and the put separately. So take a look at that. For example, okay, let's go back to Tesla. So if I look at Tesla, we know volatility is 63, but if instead of looking at the volatility, which is the mean, I look at the call volatility in blue color, and I look at the put volatility in gray color, and I click OK. Notice now I end up with two lines here, where you can see that currently, right now, the blue line, okay, is pointing at 65, and the gray line is pointing at 62. In other words, the implied volatility for the calls in blue color is greater than the implied volatility for the puts in gray color. Okay, and what does that mean? Well, that there is a clear bullish sentiment building up from behind the scenes. Okay, and again, I would not be surprised that the stock then starts moving higher. Okay, also in the case of Tesla, again, maybe I picked the wrong example. Okay, you'll see why in a moment. In the case of Tesla, earnings took place yesterday. As you can see here, I just added the E for earnings. Earnings took place yesterday, and the stock is currently trading at 1,047, which is all the way here. So the stock closed down here yesterday, and the stock is going to open up here today when the market opens in a little more than an hour. So now, is that bullish? Yes. Did you kind of knew yesterday, even before the market closed? Yes, because look at what's happening in the options arena. Okay. So again, it's very interesting to understand implied volatility, because on one hand, as I said before, if you only look at the mean, which is the red line I had before, let me go back to this. So this doesn't tell you anything about direction. It simply tells you options are cheap or options are expensive, which is extremely relevant. But then if you then break it down into calls and puts separately, so now it tells you about direction. And in this case, yesterday for Tesla, we had a bullish sentiment building up in the options arena that later translated into price movement that could be seen on the chart, not yet because the market hasn't opened, but you will see Tesla gapping up later. Okay. So anyway, hopefully the lesson opened your eye to something that is important. Now it's time to move into our market analysis, market commentary, so we understand what's going on out there. If you have any additional question, please feel free to type it. Happy to go back to the lesson and review anything that is needed. But in the meantime, I'll start moving throughout our market review so we can complete the session, because we've been already almost 45 minutes together, guys. So anyway, so we're going to be looking at the market report. It's a SMARTT report, special market analysis report for tiger traders. We're going to be looking at the climate and the cycles, the call and the put, implied volatility, options, volume map, UFOs, and all of the above, or I should say all of the below. So the market climate and the cycles is this. Take a look. We are looking on the left as the SPY, which represents the S&P 500 ETF. So what do we have here? Well, first of all, notice that on the prior day, we went from a red climate to a blue climate. red to blue, that's the climate we got. So in other words, the market has changed, okay? And based on statistical measurements, this climate is likely going to remain for 6 candles. So having a whole week of having the market to go up and maybe a slightly down one day or two, not a big deal. That's what is expected based on statistics. Having said that, note of caution, because notice how some of those dots like today are thin, where some of those dots are thick. The thick dots are the ones which represent a greater probability in our favor. The thin dots represent more of an unconfirmed situation and therefore less probable. So careful with that. I would suggest waiting for a little bit of confirmation, maybe later in the day, as the market opens, and the market is gonna open up, so the confirmation is almost there. But let's wait for the market to open up, and see the market is moving before getting too excited. Okay. Having said that, it's looking good. We have an Elliott wave turning point that was defined 2 days ago. Final target for this Elliott wave is for 60 and above. So definitely this coincides very well with AutoClimate, which, by the way, this is the tool that you can get for free. If you use this QR code, as I said before, this is the AutoClimate I was mentioning before. So AutoClimate is telling you that this should go up by during 6 days, and certainly 6 days should be time enough to reach that upper end of the Elliott wave that has just started. Okay. Now, what's happening at this moment in time? Well, at this moment in time, we have the S&P futures in a 34-minute time frame, which is intraday. It's moving up by 0.59% since yesterday close. So notice how the S&P futures have been moving higher. Not only that, new buy on field orders have been added, during the day. Okay, during our day in Asia, where the US traders were asleep, Asian traders and European traders trading US products have been adding on-field orders to buy. Okay, so we don't see that. If I move to the SPY ETF, okay, this is the same 34-minute time frame of the SPY ETF instead of futures. We don't see any green UFO here, but the reality is that from behind the scenes on the futures arena, we got green UFOs. So on-field orders have been added. So if the market opens and starts moving down because there is profit taking, the moment it comes here, it's very likely going to bounce back up, and both that Elliott wave as well as the new blue climate are likely going to push it higher, as I just said. Now, the only little bit of a concern I have is that, as you can see, I am looking here at the implied volatility comparison. I'm looking at the calls and the puts, blue for the call, gray for the put. We just covered that in the lesson. The only difference is that you can see here there is a number 3, which means I'm looking at this as a 3-day average. This is the 3-day average of the implied volatility for the calls and the implied volatility for the puts separately. And notice how at this moment in time, they are exactly matched. So there is no directional bias in the 3-day average of the implied volatilities, which coincides with the fact that the climate is not confirmed. So the safe approach, at least based on my trading plan and my style of trading, the safe approach would be to let the market open, okay, let the market define itself, and as a new dot appears here, as the market opens, a new dot in the AutoClimate will show up, and we can see the implied volatility go up. So then I would then consider that the climate is now being defined, and going long would make a lot of sense. Find stocks like we saw Prudential or any other stock based on your trading plans, and buy cheap options and go for it. That would make a lot of sense to me, given the market environment, if that was to happen. But so far, the market hasn't opened yet, so we need to find this confirmation, because my concern here is lack of definition with the implied volatilities and lack of definition with the climate. Okay, so everything looks like it's setting up for a nice environment, for a nice bullish move, all the way to this higher portion of the wave. But we need to get that confirmed by having the market start moving higher. Okay, so we need to see that as the market opens. Cool. What else? So volatility. Well, options overall are relatively cheap in the S&P. Notice how, again, if I switch this from blue to red, Okay, notice how the implied volatility for the S&P is in the lowest part of the range, 17% for the S&P. Okay, you can also see this when looking at the probability cones, where the red line, which is implied volatility, it's within the blue lines. Okay, it's inside. What does that mean? The blue lines are historical volatility. We'll need to have lessons on that. Okay, and the historical volatility basically represents the speed at which the S&P is moving. So notice how the speed at which the S&P is moving is faster than the speed at which the S&P is expected to move. Red line. What does that mean? Cheap options. So overall, options are fairly cheap. Not for every stock. You saw in the case of Tesla, they were expensive. You saw in the case of Prudential, they were cheap. So you have a mix. Some stocks are going to be cheaper than others. But overall, out of looking at the average of the 500 stocks that make up for the S&P 500 index, we are in the lower end at this moment in time. Okay, so options are in the cheap side. Hi, why do you use 3 days for implied volatility? Can we use other periods like 1 week? Yes, absolutely. 1 week would make a lot of sense to me too. Just like 1 week is, to be honest, very relevant because it's a whole trading week from Monday to Friday. Options expire on Friday. Very relevant. I just like to be just a bit faster. I don't want to be the last one entering the trade. It's too late for I'm late to the party. At the same time, I don't want to be the first one either and kind of like guess something is happening when I don't have evidence enough. So 3 day, it's where I draw the line on the sand. Okay, if you were to use 2 day, 4 day, 5 days, still fine. Just like every decision in trading, since we cannot predict the future for sure, every decision in trading has pros and cons. My rationale for using 3, I just explained. Hopefully it makes sense. Very, very good question, Mogul Week. Very good question. Mick Tian, my email address. Yes, absolutely, absolutely. Let me put that on the screen. So certainly, guys, you feel free, guys, to email me if you need to. Here's my email address, jose@tradictive.com. Feel free to contact me. Super, super happy to be in touch. Super, super happy to help you guys with anything that you may need, okay? Cool. Let's continue here with the market analysis. So what else we have to talk about? Well, volume maps. Okay, so here are the volume maps for options. Okay, this is what has been happening. So again, yesterday, very undecided day, as we can see. And we can see the ratios of calls and puts to be 1.1, 1.1, 1.2. Nothing is large. 1.4 is the biggest one, 1.3, 1.1. This is the amount of calls versus puts, right? So because it's gray color, 1.1 means you got 1.1 times more puts traded than call. That's what that means. If it was blue, it would mean that 1.1 times more calls traded than puts. But again, the ratio is 1.1, 1.2, not too many. So it's indecision, which is what we saw in the movement yesterday, where the market gapped up, went down, ended up closing a bit below the open of the close of the prior day. A little bit of indecision, unconfirmed climate with a thin dot, implied volatility of calls and puts matched. So all of this is telling you the same thing. So again, today when the market opens, the volume map will start picking up direction in one direction or another, and that's going to be critical to understand what's coming next. Okay, from a open interest point of view, I switched to open interest. Okay, take a look at this. Pretty large open interest here, 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 right? Pretty large. So this is 440, 445, and 450. Those are relevant support and resistance points. So for example, let's say you find a good trade and you get in, right? And your target is to be up here. Well, very interesting idea could be when you get to 450, take partial profits or something like that. Why? Because you got extreme high open interest at these levels, and that may act as a very strong support or resistance, okay, when you get to 450 in this particular case. Good news, if the market was to fall a bit, okay, you should find plenty of support at 445, okay? Again, the market is gonna open trading at 448. 448 is somewhere in here. So if the market opens gapping up and then comes back down and reaches 445, likely going to bounce and go back higher, which, by the way, when we looked at the futures earlier, guess what? We got at 445, okay? This is futures, it trades in thousands, okay? The SPY trades in hundreds, okay? But basically, that number, if you run it, is 445, isn't it? So we got on-field orders to buy at 445, and we got a very, very high options open interest located at 445. This should act as a very strong support. So again, if the market opens, defines itself, and then retraces a bit, stocks like Prudential, as we saw before, there are many stocks like that. Okay, this is just an example. Okay, guys, this is not financial advice, as you guys know. If one of the stocks come into a green UFO like that, you got the S&P in this 445 level. That's it. It's kind of like, everything is lining up very well for potentially a very powerful move to the upside, given my market analysis today. Okay, so that's it, my friends. That is it. We went over market climate and cycles. We went over the implied volatility and the calls separately. We went over the volume map and also the buy and the sell on field orders. We went over the interest rate map. We went over the volatility projections and how the red line was within the blue lines. So options are quite cheap. We didn't look at groups, which I could do very quickly now. I almost forgot that one. And again, here is the QR code one more time and my email. Okay, so let me go back to the platform quickly. Let's take a look at the groupings. So what's happening with the groupings? Let's sort this based on strength and long-term and short-term. So utilities, still very strong group. In the short term, telecommunications, okay? Now, in the long term, notice it's coming in. So telecommunications may be a very interesting sector where it's coming from weak to strong in the long term. So that if it's going to stay blue in the long term, that means those stocks are going to rally for much longer. Something similar is happening with consumer goods. Basic materials is all blue, long-term, short-term. Healthcare, oil and gas, all blue, long-term, short-term. But again, to me, interesting, telecommunications and consumer goods, pretty interesting sectors, because if those long-term strength levels remain in the blue side, those are going to be very long-lasting moves. Okay, so telecommunications, we have companies, for example, wireless devices. Today we got earnings for AT&T. We talked about this earlier, isn't it? So could be an interesting thing for you to watch this. If earnings is good, if you like fundamentals, earnings are good, the trend defines itself. Maybe a couple of days from now, those could be good stocks that put themselves in a good position for a trade to be taken. Of course, all of these depends on your trading methodologies, but here we go. Now you know the strongest sectors in the market, or the ones with greater potential of moves, should those markets define themselves. Very good. Putty, are the recordings of the videos on YouTube? Yes, you go to YouTube, you'll have all the recordings, also in the Tiger Broker app, indeed. How do we decide what expiration date option to buy? That, unfortunately, Putty, while I wish to answer that question properly, I don't have time to do this right. And I'm concerned I'm going to give you an incomplete answer and it's going to get you in trouble. So I'll make a note of this, and in future lessons, I will certainly cover that. It is a very important topic, and for sure that's in my list, but I may push it a bit further or closer, I should say, so we can talk about this in sessions that won't happen too long from now. Okay, guys? Very good. Thank you for your feedback, guys, your collaboration. Remember, if you're watching this live or recorded, in future sessions, do not be shy. I felt today, as some of you, a bit shy. So please do not be shy. Know that I'm here to help. And again, I myself was a student of trading at some point in the past. I had very basic questions and I was shy. Don't be shy. Or maybe the reason why some of you have been silent today is because you have very advanced questions and you don't dare to be so advanced. Please dare be advanced. I'm happy to put advanced lessons together if you guys kind of show me that you need that. Okay, so talk to me, guys. Shoot me an email as well if you prefer to keep it more private and you prefer to discuss it in an email with me. More than happy to receive your email, and for sure I'll get back to you guys. Okay, very good. You guys take care. See you soon. A pleasure as always. I missed you guys. It was a few weeks I was not around, so see you soon on the next one next week. Don't miss me next week, Thursday, same place and time. Bye bye. Take care, everyone.